when a parent transfers a home to a child, it can raise questions about taxes, reporting, and inheritance planning. This episode explains whether the IRS needs to be notified, how gift rules apply, and what it could mean if the home is sold in the future.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hello again, everyone, and welcome to this episode of Leibel on Fire. We're talking about things mom may have told you, and we're with Leibel Sternbach. Leibel, hello, and welcome back to the show.
Hey, how are you doing today?
I'm doing well. I like the title, Things Mom Should Have Said, and this topic is actually, my mother transferred the title of her home to me. Do I need to report this transaction to the IRS? I'm going to say that we need to talk to Leibel Sternbach about this. So, do I need to report the transfer of mother's home when I get it to the IRS?
So that becomes a complicated question.
It's not that easy then,
It's not that easy. So we've got a few different things that come into play here. And probably the thing that's going to give you the most headache is your state laws rather than the IRS. The state laws when it comes to gifting and gift taxes and inheritance are a lot more complicated than when it comes to the federal. So the federal government, it used to be the answer was, yes, you had to report it. You had to pay a 50% tax. And people were very upset about that. And one of the things that the Secure Act and the Secure 2.0 Act took care of was it created this concept of a universal gift, lifetime exemption. And so what that says is, whether you give the money while you're alive, because a lot of people like to give things while they're still alive and see it be enjoyed, right, while they're alive, rather than over their dead body when they can't really, enjoy any of it, right? So if you want to give your kids and your grandkids, because that's what people were doing, and that's what people are doing, is they're gifting these things while they're still alive, that instead of it being that you'd have to pay a gift tax, which was 50% over the annual threshold, and that was a very significant burden, and so people weren't gifting money. So instead of gifting that money, instead of making it a taxable event, what they said is, well, you're going to gift to them anyways when you die, so let's just make it one number, right? Whether you gift it while you're alive, whether you gift it when you're dead, it's going to be the same non-taxable event, and we're going to make that non-taxable threshold, which used to be a very low number, we're going to make that a very high number, so that for the vast majority of people, they will never pay taxes on that money that gets inherited or gets gifted to them by their parents or grandparents or by somebody who loves them.
That's interesting. Yeah. So you're telling us that when mom or dad moves the house to you, is considered a gift. So if that's the case, then are you also saying that no taxes apply?
Well, the question becomes, first, you got to answer the question, is it actually a gift, or was it a legitimate transfer of ownership where you purchased it, right? So if you purchased it for a fair market value, then it's not a gift, it's a purchase, right? If that was the case, then it's not a gift, right? And that doesn't get reported. If, however, it was a gift and they literally just gave you the title, or they gave it to you for less than the fair market value, then that difference becomes a gift. Right. And so now you don't have to pay taxes on that gift, assuming that they haven't used up their lifetime exemption, which very few people will be in that category of having used that up. But, assuming they haven't used it up, then it's a tax-free gift. It still needs to be reported, but you don't pay taxes on it. And it's got to be reported at 2 times. The IRS wants it reported on that year's tax return. You'll file a gift tax return if you're splitting the gifts, but you basically report that you gave the gift. You also have an annual exclusion that you'll want to apply, right, so that it doesn't apply to the whole. And again, it's a non-taxable event. You're just letting the IRS know, hey, this thing happened. The other thing is when the person passes and you file that final tax return, you're going to file on there and say where the money went. And you're going to say that this house, if it was transferred within 3 years' death, you're going to say that it was, this was transferred to this person, and this is, and then it'll add up all of the gifts to come up with that exclusion. And assuming it's under the exclusion, then there's no taxes due on it.
We're talking with Leibel Sternbach about transferring titles of your home and whether or not it's taxable. And the general answer so far that we've gotten from you, Leibel, is that it depends. So what happens? Okay, so now I've got the home. What happens if I happen to sell that property later on? How does that cost impact me? What's the cost basis involved?
So now we're getting into really, really complicated questions. So generally speaking, and this goes into whether you purchased it or it was gifted to you.
Okay.
If you purchased it, then your purchase price is generally the price that's assumed when you receive it. However, because of this whole gifting phenomena that's happening, and the fact that you're receiving it and you're receiving this thing that has value to it, right? It's not worth nothing. Because you're receiving something that has value, the value of that thing when you sell it, anything above that value is going to be profit. And you're going to have to pay capital gains on that profit. How much is calculated as profit is generally going to be, and this depends on when the person dies, because different rules come into play. And so, again, I advise you, if this is something that affects you, talk to a CPA, talk to a tax expert, Google it for yourself. The IRS has it on their website. But depending on your specific situation, one of two rules is either going to impact you. It's either going to be the value, the cost basis that the original owner has. That is going to be the cost basis that you're going to use. Or, again, depending on how it was transferred and when they died, it could be the value at the time that they transferred it to you. So, or it could be the value at the time of death. There's a possibility for that too. So depending on those situations, determine what number you use. But generally speaking, when something is transferred to you and then you sell it at a later date, if it's a gift, you are going to just assume the owner's cost basis in the thing. And so when you sell it, if they bought it for $1 in 1970, or let's use realistic numbers. Let's say they bought a house for $20,000 in 1970. Okay. They gift it to you in 2025. That house is now worth, $500,000. And then you turn around and sell it for, $1 million, right? So not only do you have the $500,000 of profit that you ordinarily would have, but you would also have the $480,000 of profit that your parents would have had if they had sold it, because they transferred it to you as a gift, because it was a non-taxable event.
Interesting. So you really need to sit down and really plan through this whole thing, because it seems really, really simple. Mom passed away, sent it over to me, and now it's mine. But now there are a lot of details that have to be worked through. So I'm wondering, and I think you may have answered this, Leibel, would inheriting that home instead of receiving it be a better option, or are we still talking about the same thing?
Well, so possibly. So when it comes to inheritance, and this is something that parents really need to keep in mind, depending on how you're transferring the assets and when you're transferring it. If the purpose is, if your kids don't need it while you're still alive, right? And it doesn't make a difference to them whether you give it to them now or when you pass, there may be value to them receiving it when you pass because of something called a step up in basis points. So when someone inherits something after death, the IRS kind of gifts them this one-time gift that says that the value of the thing that they're receiving is going to be the fair market value at the time of death. So if you, going back to the house example, you purchased that house in 1970 for $20,000. They inherit it in 2025 for $500,000. Instead of them having a cost basis of $20,000 and then having to pay taxes on $480,000, they receive it with a cost basis of $500,000. And so now they're only paying taxes on whatever profits from when they sell it, which is a very different situation than if they just assume your cost basis because it was gifted to them. And so that becomes a wrinkle that you got to really think about when you're inheriting it. I'm also going to throw something out as well, is something to consider is annuities. Annuities are taxed in a very different way And so when annuities have a portion that's principal and they have a portion that is the growth, and that taxes, the growth is taxed as ordinary income. Depending on whether if it's a non-qualified annuity, you don't get a step up in basis points, right? So this thing that everyone else is getting when they inherit something where they don't have to pay taxes, people who inherit your your annuities, they're going to pay taxes on that money. And so what you want to make sure is that annuity that you plan on leaving as an inheritance, or if it is left as an inheritance, gets paid out as a death benefit and it's not inherited. And that is very important that you have that distinction. You don't want that for spouses, but you want it for non-spousal beneficiaries. And usually you have to pay more to have that feature turned on, or you need to make sure that it's a feature that's available in your policy. So again, when it comes to inheritance and gifting, right, it's not a simple, easy decision. You got to really plan this out for the asset type and how it's going to be used and how it's getting transferred.
What can we find at yieldsforyou.com on this topic? It sounds there might be like a checklist or do's and don'ts associated with this label.
Yeah, so we have a few resources when it comes to this. So we have a 5-minute estate planning guide, which I highly recommend that everyone go through. And it goes through kind of some of these considerations. It's more at a high level, right, to make sure that you've got your T's crossed and your I's dotted when it comes to an estate plan. And it tells you, the questions to think about and what are really the important things. Because for a lot of people, this complex planning may not be the most important thing. Maybe, a lot of times it's usernames and passwords so people know where things are and what they are, right? So it goes through, what those considerations are. The other resource, there's a download that has a whole bunch of guides in there. And when it comes to these specific questions of, someone to inherit a house, a business, whatever, there's a bunch of workflows that you can go through that'll help you decide what is the best way to do it. Should you gift it now? Should you gift it upon death? There's various considerations over there. And again, like I said, right, everyone's situation is different. Reach out to us. More than happy to take a look and give you our 2 cents on what we think, keeping in mind that we're not lawyers, but we are financial planners. And we are tax, advisors. So we will give you that perspective from our perspective as being an advisor, what we think is advantageous and what you should look at. And what are the conversations that you should have with an attorney if you should have it, because there are a lot of nuances, including something that most people don't consider, they don't realize, like the state of Florida, most of the counties, the way they fund themselves is by people passing who are non-residents. There's a huge tax for non-residents on inheritance, and specifically property. And that's how they fund their entire government. It's how Florida and the counties are able to maintain, zero income tax, is because they're living off of all the non-residents and recouping their money there.
That's really something to keep in mind. We've been talking about what seems like a really simple topic of what happens when parents transfer their properties to their family members and so forth, but it's more complex than that. And you can find the details, as Leibel has just talked about, at yieldsforyou.com. So as I mentioned, passing down a home involves a little bit more than just the title change. It can impact your taxes. It can impact Medicaid. It can impact inheritance strategies. Do you have the right one? With the right planning, families can make the best choice for both parents and the children while avoiding costly mistakes. I'm Freddie Bell for Leibel on Fire, and we'll see you again next time right here.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.